Welcome to OpalesqueTV. Today we have Jeff Kong, Portfolio Manager at the Tradex Relative Value Fund. Now Jeff, you have a fascinating background and pedigree in the alternative investment industry. Can you talk to us about your experiences at your past hedge funds and what led you to Tradex?
Thanks, Greg. I started in this business almost 30 years ago when I joined a young investment bank called Greenwich Capital Markets. I was hired there to do trading analytics for structured product. 12, 13 years later, I ended up on the buy side at SPM. I was hired there to manage the single flagship portfolio called SSH when we had just gotten in $25 million to bring our AUM to $35 million. 10 years later, when I left, the firm had over $2 billion under management, of which more than half was in my fund, SSH. Over that 10-year time period, my fund annualized at 23+% net, and my only down year was in 2008, where I was down 6%. But that situation led me to be able to return 135% net in 2009. That performance led to the fund being named the #1 large hedge fund in the world by Bloomberg Markets, and it was number 8 on Barron's Top 100 list. Once I left SPM in 2010, I joined Passport Capital by invitation from John Burbank, who was an investor with me out of his foundation. And our goal was to launch a fund to trade the structured credit products, which I did for, starting in 2011 through most of 2013. Unfortunately, Passport was unable to raise money for my fund, even with great performance. And in the spring of 2013, John called back his capital, and so I had to liquidate the portfolio. We still remain on very good terms. It was just an unfortunate turn of the business. Meanwhile, my partners, Michael Beatty and Richard Travia, who were investors with me from their fund of funds here at Tradex for almost a decade, had approached me to run a white label fund for them. Once I left Passport, it just seemed natural for me to do it from the Tradex platform. And that's how we arrived at being partners in this current business.
Jeff, give me an overview on the Tradex Relative Value Fund and the particular strategies that you run in your portfolio.
So here at Tradex, what we are striving to do is to replicate the features of my previous endeavors that were very successful and improve on those things that were suboptimal. And so the portfolio that we trade is a market neutral absolute return strategy with 3 different trading sleeves. The first sleeve trades agency, Fannie, Freddie, and Ginnie mortgage-backed securities that are prepayment sensitive. And those we hedge with liquid instruments in order to neutralize all the risks that we are unwilling to take, such as interest rate risk. The second sleeve trades the most liquid assets in the fixed income markets, including U.S. government bonds, as well as the raw components of agency securities, the pass-through assets. The third sleeve is an opportunistic bucket where we could house pretty much any outsized opportunity that doesn't fall into the first 2 categories.
And how does TRV differ from your previous funds?
I really believe that my investors should be able to take advantage of my experience and expertise across the entire rates and credit markets, not be limited to a very narrowly defined subsector of a single market. And that's why, in contrast to the fund I ran in the past, we've designed this fund to have different trading sleeves.
So what does drive your returns?
Our goal is to arbitrage the market by looking through the assets to see where things may be mispriced and to use that knowledge in order to accumulate cheap securities that have a high amount of carry. And so our goal is to retain as much of that carry as possible and offset any of the risks that we are unwilling to take, such as interest rate risk. So that's why I call it a market neutral strategy. We don't maintain interest rate exposure. Additionally, because I'm in entirely agency and government securities, there is really no credit risk per se because all these assets are guaranteed. And that's the majority of what it is that we trade. Our process is both a top-down and bottom-up approach because we want to look at the market at large, look at the risk appetite of the global financial markets, but similarly, we want to look down very granularly at the assets that we invest in, and so I think that that's a good way to be able to find out what sectors make sense and then define the best assets in those sectors. So rather than trying to pick up nickels in front of a freight train, we look to markets that are maybe have less focus on them by the very large firms. And they're also ones that may have perceived risk that's greater than the actual risk. Our proprietary models and our viewpoint is what can mitigate those risks.
Jeff, the markets and a lot of hedge fund managers have had a very difficult 2016 so far. 2015 was also very difficult for many managers. So how does your hedge fund and your approach differ?
These last few years have been challenging for most investors primarily because of the hyper liquidity in the market, pushing down risk premiums and causing yields to be very low for all types of assets. You know, trying to take a directional bet in this environment can be very, very challenging. And what we do that may be different than others is by running a market neutral portfolio that does not have directional exposure. We only take exposure to the things that we're interested in. And one of the main things that we are studying is prepayment behavior, because that's an area that is almost more of a behavioral science than it is a financial one. Because, home borrowers don't always react to the incentives that we might think they would react. And the reason why that occurs is because their decision is often based on many personal factors, such as their household income, their credit history, the size of their loan, their geographic location. And these are really the governing factors as to what's going to cause a person to take advantage of a refinancing incentive you might see in the market. And the study of that behavior and pitting our opinion versus the market's opinion can lead to alpha generation.
Tell me more about your Opportunistic Sleeve, which TRV is allowing you to bring to investors.
The third sleeve I mentioned, the opportunistic bucket, is a placeholder to house assets that wouldn't fit into the other two buckets. It arose out of a historical event where in my previous fund, we wished to short the subprime market, similar to some other very famous funds. And we did so in 2007 very successfully, but because we didn't have enough time to raise a large amount of capital, we were only able to do a nearly 200% return on a very small amount of internally funded capital. By incorporating it into a single fund, I can allocate my investors' capital to that sleeve when the opportunities exist. One unique feature about the fund that I had done in 2007 was in shorting the subprime market. That was generally a negative carry trade, but because of the way that we designed it, it was actually a positive carry vehicle as well. Currently we don't have anything in the opportunistic bucket, but we do believe that there will be opportunities to achieve outsized return, particularly in fixed income and in the credit space.
What are your views on investor transparency? How has it impacted you in the past, and do you expect to change anything in the future?
One very important aspect that I've brought with me is investor transparency. We don't have a black box here. There's no secret sauce. There is a great deal of experience and a proprietary model that we're happy to share how it works with our investors. And I think this is important, and because in the past it really led to a great deal of trust. In fact, in 2008, when during the heat of the crisis, rather than having mass redemptions, because we were able to explain to our investors what the opportunity was, my fund had no redemptions, and that allowed the investors to stay in and take and benefit from the return in 2009.
Why is experience so important to your particular strategy? And how do you expect that to play a factor as we go into a rising rate cycle?
There are actually very few traders, that have been in this business as long as I have. And I've had the benefit of seeing all the different cycles that we may have been through, whether it's rising rates, inverted yield curve, a terrible financial condition during the crisis, and then to have traded through all of those conditions. Many of the traders that are out there today have really only been around, less than 10 years, which means that they've only been trading since the crisis and have seen, purely a bull market.
In your opinion, how should investors be looking at mortgage credit today? And do you expect the maturity of that trade to benefit your strategy?
So often when I mention the asset class that we invest in, people mistake it for being the mortgage subprime credit recovery trade. A lot of investors globally have exposure to this asset class. This is not our primary asset class. And, I think everyone knows that we're at the latter innings of that trade, and the beta is all but gone away. My trade is completely different than that trade. It's not a credit trade. It's not a subprime recovery trade. It's really it's an evergreen strategy that looks at prepayment behavior in the agency space. And the agency market is a robust market that has a lot of existing bonds as well as new issue bonds that we can take advantage of.
So why is now a good time for investors to be looking at TRV and your strategy?
So just as we've seen in the past, different points of stress in the market and different times of volatility, those times can lead to problems for some funds, but we view that as opportunity because of the nature of our risk management, leverage policy, and cash management. We are able to take advantage of volatile times. And I think that our strong current carry, and the all-weather nature of this strategy, combined with being able to have dry powder to take advantage of volatile times and cheaper assets, is what led to the success of the strategy in the past and will lead to this success of the strategy going forward. And I think now is a really good time to examine such a strategy because we're looking at the potential for the Fed action that's going to monetary policy that's going to impact the markets, and clearly, risk appetite is going to change over time, and I think that we are very well suited to take advantage of those situations.